This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Daniel back on the show, but now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Daniel's picture saying, looking for the downloads. Now, Eric, let's start with crude oil.
I don't have EIA inventory this week. Due to my travel schedule, I haven't been able to pick up the data in time for this report. The vigorous bounce that we're seeing off the lows is a result of rising geopolitical tension after President Biden greenlighted strikes using U.S. weapons deep into Russia, something that he swore he would never do because he understood that it was provocative and risked causing a nuclear war. Apparently, he's changed his mind or forgotten that's what he said or something, since those promises were made early in the conflict. In my opinion, the U.S. is acting incredibly recklessly and irresponsibly right now. It appears to me to be as simple as trying to sabotage President-elect Trump's promises to end the war by escalating it in a way that would make it impossible to end. I don't have any other explanation.
Eric, when we look at the crude oil chart on page 2, I drew on there the support line that was established over the last 3 months down around the $67 area. And so what we have is a scenario where crude oil has found support, but is still in a primary downtrend. The pattern of lower highs, lower lows, all rallies fading has not yet changed. And so with this bounce that we saw in crude oil, we're going to get a very important test here where there's a descending trend line, moving averages that we're coming into in retracement zones all around the $70, $71 area. And if crude oil fails in this $70, $71 area and rolls back down, not only is there room for it to retest that low, but that support line, after being tested so many times, may very well give out for one quick crude oil washout that could see a quick drop down into the low 60s. Even if that kind of a technical breakdown did happen, I would view that as a short-term buying opportunity to fade it back into this trade range. Overall, I think that this is a fair value of crude oil, and the only thing that is that there just hasn't started anything bullish yet. And this may be the story for the remainder of the year. At some point, there will be an opportunity to make money on the upside of crude, but we're going to be looking for the technical signals that trend has shifted. Nonetheless, let's move on. Eric, what are your thoughts here on the equity markets?
Patrick, markets are still digesting the Trump win and the cabinet picks and what it's going to mean for markets. I don't see any real strong directional trend here. I don't have any strong opinion myself.
Well, Eric, on page 3, I have the chart of the S&P 500 and drew on that rising wedge formation that the S&P has been following in upwards fashion. Now, we have a big event with Nvidia's earnings that hasn't created a big reaction, but certainly was an event that everyone was much anticipating. I look at this in a very simple way. This is exactly the levels right around this 5850 to 5900 area where the market should find support and be bought on dip if the channel on the upside will remain intact. And that would open the window for a rally to 61 to 6,200 on the upside. These support lines, though, do need to hold. Now, Nvidia was that important. It was the idea that it could potentially be a trend shifter that could have broken this market. At least at the time we're recording this, that hasn't been the case. And if Nvidia doesn't become the catalyst, then the flows of the market could end up keeping this market in this channel deep into the holiday period for the next 3 to 4 weeks. On page 4, I do have that chart of Nvidia, and you can observe the same type of a rising wedge formation. Now, the initial reaction on Nvidia at the time of this recording has been a little bit of a lower open, but by no means a big percentage move. In this same situation, so long as Nvidia doesn't have any meaningful breakdowns below $100 $130 on the downside, then you can still assume that this stock is maintaining its primary trend, and the window for an upside move would not be closed. At this moment, this is going to become pivotal for driving the sentiment of the markets in the bigger context. Now, on page 5, I have the chart of the Euro Stock 50. Now, Europe has been incredibly weak, has been rolling over, and I have a bigger thesis that the global developed markets have been going through one big topping formation throughout much of the year. The only performance has really been in the S&P 500 and or the NASDAQ. And what we see here is that the S&P still continues in its primary trend, but these indices simply have not performed since the first quarter of the year. So Eric, let's move on and look at that US dollar index.
The Dixie is consolidating between 106 and 107. That begs the question, is the Trump trade, has it played out, meaning the dollar is topping out here and maybe it's about to reverse to the downside, or is it just pausing to catch its breath before moving even higher? I don't have any really strong view on which. It's feeling to me like maybe it's topping out, but let's wait and see. A daily close below 106 or above 107 on the Dixie is the tell to watch for.
Yeah, on page 6, I have the chart of the US dollar index, and I very clearly drew on this 2-year trade range, the highs and lows, and we are directly testing a key overhead resistance. Last week, we talked about that euro trading right down to a very critical 105 level. Now, typically, this type of a resistance level should stall or pause the price action, and it has. And so where this is actually a very critical moment, because if the big picture macro conditions have genuinely changed because of the change of the administration, then we could see this 2-year trade range broken. And this is actually incredibly important to see, because if the US dollar breaks out above the 107 level, there really is no resistance for it to stop until it reaches its 2022 levels up in the 112 to 114 area on the upside. And if a dollar started that kind of a rally, there's going to be huge macro implications on almost all asset pricing. With that said, Eric, let's move on and talk about gold.
Already, we've seen more than $130 bounce off the lows so far. So the question is this just a dead cat bounce before lower numbers are still to come? Or has the Trump trade bottomed out and it's all uphill from here? I had previously been leaning toward the scenario that this was likely just a bounce and we might not have put in the final low yet. But President Biden's aggressive provocation of Russia, seemingly trying to start what could turn into a nuclear conflict before Trump can take office, could easily take us to new all-time highs. Similarly, if cooler heads intervene to stop this U.S. provocation of war against a nuclear state, something I don't think is advisable, well, if we came to our senses and stopped doing those things, we could see a downside reversal in gold. I do think it's because of this geopolitical tension that we've seen such a vigorous bounce here. We are above that point where I thought the bounce was going to stall out. So maybe it has legs. Let's see what happens. I think it's going to depend on the geopolitical news flow.
Yeah, Eric, when thinking about what happened here in the last couple of weeks in gold, the sentiment a few weeks ago was just so bullish. The consensus was that gold can only go up. And inevitably, there becomes a period where the market tests the resolve of people to stay in those trades and create some sort of a short-term corrective washout. We now have done a 50% retrace down towards its 100-day moving average. And that has now initially found a key support and a bounce in gold. We're now approaching what I think is a very key level at 2,700. 2,700 was this big target that we all talked about for most of the year as an upside kind of level to be looking for gold to achieve. And here we are now approaching that 2,700 level again. In my mind, if the bulls can beat 2,700 and consolidate us in that 2,700 to 2,800 level in the coming weeks, that leaves the window wide open for gold to even make a move to 3,000 going into January. At the same time, if 2,700 isn't beat, then that means that gold remains in some sort of corrective pattern. And a corrective pattern, like for instance, the one we had through April all the way through June, was like this 3-month consolidation. It was more sideways than it was downwards, but it was a consolidation period absorbing the previous bull advance. And anything below 2,700 would leave gold in this kind of meat grinder trade ranges that in consolidating potentially for the remainder of the year. We're literally approaching 2,700 and we're going to get a big tell here very shortly. Now, moving on, Eric, I wanted to just touch on copper. And really, I just wanted to highlight that it was quite a breakdown that we saw in the last couple of weeks. And while we're getting these little short-term bounces, overall, the primary trend now is in the sell cycle. And now, while it's a downtrend and it is actually pretty bearish price action, to counter that, we're approaching some pretty key support lines below. Is there room for, 25 cents more on the downside of copper? Sure, but we're well off of the $5 level up at the top side. So inevitably, we're going to reach a point where copper is going to establish a bottom and be cheap in terms of a long-term investment. And so I think it's more of those scenarios where it's likely copper is going to be in this grinding trade ranges for potentially the remainder of the year. But these price levels will probably end up being levels where some really good opportunities will emerge in the first quarter of next year. Now, moving on to uranium, my position is pretty straightforward in terms of the fact that we've been in a 6 to 9 month correction in spot uranium. On page 9, we see that spot uranium physical trust. And this is the type of conditions from which a bull breakout could happen. We'll see whether the U308 spot prices can sustain up into the mid to high 80s and this start breaking back above $28 to really show some sort of bigger accumulation cycle is underway. Certainly uranium equities are getting a lot of love here, and so it'll be interesting to see whether spot prices of uranium start to confirm that.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.